All right, welcome to Peace of Mind Radio. I am Brian Ramsey along with Eric Douglas and Isaac Lafon. What's going on, fellas?
Good morning. Friday,
but you are listening on a Wednesday.
That's right.
That's right. It is Friday. We're recording the show. So today we're taking a little bit different spin. This actually is a result of a conversation I had with a client, and when I brought it up to these guys, they're like, "What in the world? What conversations you have with clients?" It simply was a question the client asked, and I explained it best I could, and wound up being a great little conversation. So I thought we'd do a show on it. What we're talking about, and we're going to put a little bit different spin than even my conversation with my client, but what we're talking about today is just the impact of the dollar. Now, we're going to tackle that from a couple of different perspectives. Number one, we're going to, first of all, talk about kind of what's happening in the markets today, give you a little general overview, and then how the Federal Reserve used currency, or the dollar, in the current market conditions, and then what impact that has. And then number two, we're going to talk about this weird thing called fiat money. If you've never heard that term, you got to listen to the whole show because we're going to tackle this towards the end. It's kind of the teaser. And this is one that Isaac is going to love to talk about. We've already determined that.
I mean, hey, I don't mind, but Brian, it's about like the trust planning a couple episodes ago. We'll just leave it. Brian is very excited about this.
No, well, anyway, we'll keep going. But anyway, we're going to talk about fiat money and what it means. And then we're going to sort of wrap up the show talking about, the state of currency that we all use. It's not the same as what my parents grew up on, or even their parents grew up on. It's totally different, and we're not talking about the digital currencies that you hear that starts with a B. We're not going to talk about anything like that. But it's in concept how actually currency changes hands. That's what we're going to talk about. So let's get started. It is it the 21st today? August 21st?
Today is, yes.
Okay, August 21st of 2020. So depending on when you're listening to the show, this is when we're recording it. It will come out on Wednesday. And by the way, if you want to catch any of our previous shows, just go to our website. You can go to wherever you download your favorite podcasts, download all of our episodes. You can go to our YouTube channel. You'll see all of our previous episodes. And by the way, if you have questions or you find that we're pretty cool and interesting and you want to have a sit-down conversation with us, we don't charge. You can come in. You can talk about anything you want. If you want to come in and talk about fiat money, schedule a meeting with Isaac. He'd love to have that conversation with you. But right behind us, you're going to see our contact information and our website, or our email address. If you want to contact us, reach out to us. We'd love to hear from you, and we'd love to meet you too. So we offer that to everybody. All right. Current market conditions. It is August 21st of 2020, and what is going on in the markets?
Well, we're pretty much back to where we started the year, amazingly enough, as far as the S&P setting new records as of this week, right? I think they hit a new high. The NASDAQ hit a new high a few weeks ago.
35 times.
Yeah.
35 times the S&P set a new high this year.
Yeah, it's been
The
mind-boggling.
NASDAQ. Sorry, I said S&P was NASDAQ.
Well, the NASDAQ, the NASDAQ just hit a new all-time high this week for the first time since February, right before the market crashed. But it's really mind-boggling when you look at everything that's happened within the economy to understand that we're hitting new highs in the stock market, and it just leads further credence to the theory that the stock market is not the economy. They are two separate and distinct different beings. So that's essentially where we're at right now.
Yeah, I mean, I think it is, if you were ever trying to educate a client on how they are not directly correlated on, day to day, month to month, this year is the prime example. So, it is maybe a good example of American optimism. So that's a plus.
Yeah, well, for sure. Yeah. What's shocking to me, I heard this statistic, and then we'll get into more about this, but this is just an interesting statistic. So Apple, right? We all use, I mean, for the most part, we've all had some Apple product in the past. I'm a non-Apple guy, but I'm a Samsung guy. But Google's market value just topped $2 trillion. Okay, so the worth of that company is $2 trillion. Think about that. Let's see, I hope I get this right. I may be off, and I'm sure I'll get emails from somebody saying, no, it's this. But if you look at the market value of the S&P 500, Apple has a larger market value than the bottom 400 companies combined in the S&P 500.
Yeah.
That's staggering.
Yeah.
It's amazing.
Those really large tech companies at the top of the S&P really drag a lot of that along, for sure.
Yeah.
Well, those top six, the top six tech companies, your FANG companies, right? Your Facebook,
Yep.
Apple, Amazon, Google, et cetera, Microsoft. Those are the ones that are really propping up the market, the performance of the overall market as a whole. So when you look at the performance of the S&P 500, it's really predicated on what those top 5-6 companies are doing, because they're, I mean, if you were to remove the top 6 companies out of the S&P, which make up about 29% market share currently, as of, I think it was earlier this week. So obviously it's going to vary a little bit on a day-to-day basis. But if you take those companies out, the market's still down 10%.
Yeah. Oh, yeah, it's crazy. All right, so here's so that's a little bit about the markets, but let's talk about what the Federal Reserve has done. So let's do, kind of go back in time a little bit. So back in February, when all this COVID stuff started to hit, one of the recommendations by our federal government was to help mitigate the spread of the virus. They wanted to shut down gathering places, right? That's kind of what happened. So when that happened, the market essentially fell off a cliff, and rightly so. We essentially shut down 50% of the economy, or maybe a little bit more than 50%. Now, we all know the tech side and all that did great, but essentially they shut down, let's say, 50% of the economy. Now, when they did that, the Federal Reserve has some things in place they can do, right? So to help mitigate any sort of, heading into a recession or whatnot. So here's how I want to kind of bounce this around. So one of the things that the Federal Reserve has at its, in its toolbox, if you will, is it can lower interest rates. Now, it's not interest rates you and I borrow. That's the big, huge misconception. The Federal Reserve only lowers an interest rate that banks borrow money from the Federal Reserve. Now, I'm not going to get into why they do that, but the banks have to borrow money from don't have to, but in most cases, the banks borrow money every single night from the Federal Reserve, and that's the interest rate that they pay the Federal Reserve. That's the lending rate, the Fed funds rate. Has nothing to do with going to buying a car or buying a mortgage or, what your credit card is. It has nothing to do with that, although banks pass that along. But, all right, so one thing that the Federal Reserve can do is to lower the Fed funds rate. Any thoughts on why they would do that, or kind of what the impact is when they lower Fed funds rate?
I mean, obviously, if they lower the Fed funds rate, the banks are going to be more active, right? If it's less expensive for the banks to get to the money, then that can help stimulate the economy. So, the general logic is that if you can get the banks to lend where there might be lending or there might be growth opportunities, make it easier and cheaper, then that should, at least where, to your point, they're shutting down a big portion of the economy, they can at least try to bolster the rest of the economy that still exists. Right, that's what they're doing when they're lowering that rate.
It ultimately makes credit more accessible to the general public.
Yeah.
So if the bank is borrowing at a lower rate from the Federal Reserve, well, in turn, for them to lend out or loan that money to a general investor or a general consumer, they're not going to have to charge as much on their interest rate to earn money on that loan.
Yeah.
So it makes credit far more accessible to the general public, which this year has been very important with so much of, so many people having to go on unemployment and having to, use their credit cards more often and things like that.
Yeah. What's most interesting about the Fed funds, if you follow it, if you're a historian or you want to go back and follow it, it's really interesting how when the Fed funds raises interest rates, and typically they do it a quarter point at a time, every 6 weeks they meet during good times. It's interesting how that quarter point doesn't always won't always translate into the interest rate you get in your checking account at the bank.
No.
Right? But when they lower it, it happens to be, percent for percent. So, and just as a point of reference, I think the Fed fund was up to like 3.25%, 3.5%. I get it's one of those, but anyway, back in January, February, and then they essentially just shut it down to zero in one meeting. They had actually had an emergency meeting and shut it down to zero. So that just kind of gives you a frame of reference. Mm-hmm. All right. So one thing they can do is lower Fed funds rate. The other thing they can do is they can provide stimulus to the economy, and this really the only way they can do it is by Congress, and Congress is what is kind of what they've been doing. So we're at stimulus 4 is under discussion right now. We don't know what that's going to be, but basically stimulus 1, 2, and 3, I think was around $6.5 trillion, something like that. So when the Federal Reserve comes out and says, or the Congress, this is an air quote, so if you're watching me on YouTube, our YouTube channel, you can see me, but if you're listening on podcast, I've got air quotes. When they borrow money from the Federal Reserve, what does that do? Why would Congress go and essentially just borrow money from the Federal Reserve? What's their intent by doing that?
Well, they're pumping money into the system. I mean, it's really pretty simple. They're just trying to get money out to as many people as they possibly can, or at least in theory. Maybe in practice, that's another story. But in theory, they're just pumping money into the economic system to keep economic activity up. So whether that's in the form of stimulus, whether that was in the form, in this case, PPP loans that went out to a large number of small businesses throughout the country, they were doing that just to help keep some of these businesses afloat and keep money in their pockets, basically.
Yeah.
Yeah. So I mean, as far as the physical paper, I mean, they make new paper sometimes just to get rid of old paper. But a lot of times they're making more. So you're taking, let's say, there's a certain amount of cash out there in the United States, whether it's in an account or it's in actual paper.
Yep.
But they're actually making more U.S. dollars that exist. And so they have the ability to take this amount of U.S. dollars totally available, and then they can just increase that number.
Yeah.
Just arbitrarily.
Yeah. We're going to get there. I mean, we're going to talk about all that. So if you want to know why we're kind of giggling about that, make sure you stay tuned because we're going to talk about how that happens. But so you guys are right. Yeah. So it's essentially providing liquidity to the markets. That's really what it is. And the reason they do that is because in this particular case, and we're not going to talk about 07 and 08, totally different structure. This was unforeseen, kind of a sudden economic issue that was going to drag this economy down in who knows what direction. I mean, it would obviously down. We know that direction, but I'm talking about the overall impact. It could have been severe. So one of the reasons the Fed will do that, okay, is they inject money into the system, and Congress does that as well, is because they were really trying to mitigate the negative economic growth. So essentially we were in a recession, right? Shortest recession on history, by the way. I don't know if you guys saw that.
It was.
Shortest recession. Now, recession by definition, let's keep that in mind, right? So 2 quarters of negative GDP growth.
There's still a lot of people hurting right now.
Yeah, for sure.
Yeah.
But really, even though we were in a recession, and it was a very quick recession, I do believe that the Federal Reserve was correct in their actions, and Congress, even though I don't always agree with much of what Congress does, I do think they did the right thing, because I believe they were trying to mitigate a Great Depression. And I absolutely think that's where we would have been heading had they not intervened and injected a bunch of cash in the system.
Well, we had conversations about that when we first shut everything down. I mean, it was pretty clear to see the early economic data that was coming out before those stimulus checks, before the CARES Act was passed.
Right.
Those conversations we had here internally, we were not using the R word, we were using the D word. Yeah. Depression, far more than recession. Yep. So that's absolutely true. Yeah.
So there are reasons to essentially, and this is air quotes, borrow money again. Mm-hmm. And one of it is to offset a recession, offset a depression, and that's really, I think, where we were headed. Now, that's been cleaned up. Who knows what's going to happen down the road? At some point, we're going to have to wind up paying for all this. We all know that's another conversation. But all right, so let's talk about this question. This is another question that came up during my meeting with my client. And she said, "Can I ask you a question?" I'm like, "Yeah, sure. Ask me anything you want." And she said, "Where, this $6 trillion that the Federal Reserve had just allocated, where do they get that money?" And I said, "Well, that's an interesting question." So we discussed it for a few minutes. I'll just kind of round the table. Where does the Federal Reserve get this money in order to provide for this spending that Congress approves? Where do they get the money?
Well, they just kind of pull it out of thin air and run it through the printing press, right?
Yeah.
It's really.
They have a building.
I don't want to make it too complicated here.
No, so that's one way, right? They just start
Yeah.
printing more money, right? I mean, that's one way.
Yeah, they did, or they infused some numbers through software, right?
I mean, if we did that, we'd all go to jail. But they don't. But you're right. I mean, they can just create a number on a balance sheet and say, "Hey, this is." Now, the other way they can do it, which is a little bit more legit way, is they can issue debt, right? They can issue long-term debt, and this goes back to, this complicated but necessary relationship that we have with adversaries. One being China, is that China and other countries that don't particularly like us and we don't particularly like them, they are buyers of our debt because we are the safest country in the world as far as investing. And, there's no other country in the world that's like the U.S., plus we have a lot of it. And so they which is staggering to me, they'll buy a 10-year bond for 0.6%, and they'll do that all day long, which is bizarre to me. But but that's another way to do it. So, there's multiple ways the Federal Reserve can, put an asset on the balance sheet in order to create cash to then provide for these, stimulus 1, 2, 3, and stimulus 4 if it ever gets here. But that's the ways the Federal Reserve can create cash. All right, so when the Federal Reserve, when things like this happen, we start borrowing money, we start injecting cash into the market, and they injected it, as you mentioned a minute ago, by the unemployment, extra $600 that was in everybody's paycheck, and I think that ended the end of July, but it looks like that's going to be continued to some degree. And then the PPP loans, we have the EIDL loan. Did I say that right?
Yeah, you did.
Just remember, I never get those initials right.
I know. You get, as long as you get the 4 letters, I think it's fine. You can mix them up all you want.
That's true. That's true. But anyway, so there's multiple ways to get money in the market. Now, how does that overall affect the economy when you're just pumping cash into the system? What's the overall effect to the average person?
Well, in the short term, it's certainly a bonus. I mean, there's from a short term perspective, it's much needed in regards to what we needed at the time because of the lockdowns and the shutdowns that were occurring throughout the country. When you take a longer term perspective, ultimately, when you're pumping this much more money into the system, you're going to create a number of different things, none of which are going to be super wonderful, but the most obvious of which is going to be inflation. And because you're pumping that many more dollars into our economic engine, you are reducing, in turn, the value of one individual dollar. So because you're reducing the value of a dollar, you are, in essence, making it, well, obviously less valuable, which is going to create or generate inflation over the long term.
Yeah. I think what's interesting, that's the economics of it.
Yep.
Right? Like that's what, when you're doing your MBA program, that's what they're telling when you're studying how that works. But think about how much money they infused back in 2008, 2009, right? Have we seen a lot of inflation since then? We've had basically very, very low, not the Fed rate where it is now, but we've never gotten back to kind of a normal Fed rate since then. Infused the money, we haven't kind of reined that back in since then, and we haven't seen the inflation. So there's the theory around that, and then there's the actual reality of what's happening. So I think it's more theoretical on the inflation than what actually may occur, and it's kind of leads down to where Brian's going here, that in some ways it should, right? To Eric's point, you put more money in, inflation has to occur, but doesn't necessarily, because we're one of the biggest purchaser as a country. We consume a ton, and so it's really consumption drives a lot of prices too, not necessarily always our amount of currency. So it's interesting. I mean, we've all taken those classes, and then you look at what happened to fix the economy after the mortgage crisis, and then what should have transpired. But then we went on the longest bull run and didn't do much of that, fixing what happened there. I don't know. I mean, what do you guys think?
Well, it is worth noting the Fed tried to raise rates a few times.
Yeah.
Because
they got it from 0 to 3.5 or 3.25.
Yeah,
so.
And so every time they did that, you saw corrections in the market immediately.
Yeah,
that's what happened at the end of 2018.
The
fourth quarter of 2018. Yep. I mean, we ended up going negative that year for the entire year because we had a really bad fourth quarter. And so
well, let's be honest, that was a little bit politically motivated.
Well, there was
that increase.
well,
I mean, when you have the President of the United States calling your Federal Reserve an idiot, I mean, when he I mean, then he comes out day before Christmas and says, no, I made a mistake. And he's like, oh, okay, here we go. Yeah. And then they rally,
Well, we can turn this into a political podcast.
No, we're not.
One of these days, I'm dying to do that, but it won't happen today.
I'll let the two of you do that because I know that you guys are wanting to do that.
But yeah, I mean, so it's been tried, and every time we kind of dip our toes into those waters as far as raising rates are concerned, there's been an immediate backlash. There's certainly not an appetite for that. So to your point, I mean, we have these sustained artificially low rates, and you keep thinking economic theory would indicate that at some point that has to change. That bubble has to burst. It hasn't burst yet.
Yeah, I think we have a lot of advantages as a country, just being a consumer society, is that people around the world, to Brian's point, want to do business with us, want us to lend us money, and you look at the value of $1 and then what they're lending it to, it's not even zero sometimes. Sometimes we're borrowing money at effectively negative rates.
Mm-hmm. Yeah.
Right.
For sure.
And so there's people, sometimes they love to politicize what the national debt is and think about that. And for sure we overspend. But it is just interesting as a country, we have a lot of advantages around because we're consumers, because people want to sell globally. They want American society to participate in what they have to offer. And it sometimes can let it, frankly, we're getting away with some really low rates and printing money or not even printing the money should cause inflation, but we just haven't seen it. So it's interesting because there's theoretical and then actual, and it's a very interesting. And I think if people are honest, there might be some really smart people somewhere that can really think what might be in 10 years, but it's hard. In this room, we don't know. I'll just be clear.
Yeah. Well, and we talked about issuing debt. At the end of the day, I mean, America still has the safest debt. I mean, where else would you go to buy debt that's going to be safer than what we issue? I mean, Germany, no. I mean, the negative interest rates, you see what's happening across the country, probably across the globe. All these other economic engines have been shut down. So, I mean, we're kind of looking at America through a microscope right now. But when you step back and take a macro view of what's happening in the world, I mean, Australia is still completely locked down. They're not letting them, you can't go out of your house right now. And so all these other economic engines throughout the world are in far worse shape than what ours is.
Yeah.
Yeah, I would put a little different spin on it. So when we're talking about injecting money into the markets and all that stuff you guys said, I 100% agree with. But the other thing I think that's interesting is when you flood the market with cash, it affects everybody a little bit differently. So, for example, small businesses, they will have a tendency to borrow money, right? Because it's at a lower interest rate. In theory, again, that's the air quotes, in theory from the bank, is they're now able to borrow money at a lower interest rate. And so they're able to expand their business. That's why you'll see a lot of small businesses will have a tendency to expand greater coming out of a recession because, in theory, borrowing money is less expensive. They can do capital projects and expand their business. And I know that's one thing we're experiencing right now, right? We won't go into all that detail, but that's one thing that we're looking to do is take advantage of the current market conditions and prepare for when we're completely out of it, we're in a better position.
Where we think things are going.
Yeah, exactly. And so we're able to, again, borrow money at a lower rate. And that way, you can either refinance debt or you can go out and borrow new debt, is what I'm saying. Now, on the other side of it, which is one of the things that has absolutely shocked me, is how real estate has continued to change, right? So there's people buying houses, people refinancing their current debt. But it's amazing how we've had clients that said, hey, we actually have a partner. I can hope he doesn't. I won't point him out. But anyway, we have a partner that was looking to move. And I thought to myself, well, what a weird time to want to move right now. And lo and behold, tried to go out and look at 3 or 4 houses. And you know this in more detail than I do. But went out and looked at 3 or 4 houses and literally said, hey, I love this house. It's great. Let's go sleep on it. Wake up the next day, it's gone. Found another house. Oh, it's a great house. I really like it. Let's go to dinner and have, talk about it, call the realtor back, it's gone. And then wound up buying a house, which is great, and then put his house on the market and literally sold within a day. or 2.
I mean, less than he had offers. Yeah, I forgot how many
Yeah.
offers he had within 24 hours. It was 3 or 4.
Yeah. So again, that goes back to just confidence in buyers and sellers, right? But it also goes back to the amount of liquidity that's in the market and banks willing to lend that money on real estate. So I just think there's a trickle-down effect when it comes to money in the market. Yes, there's inflation, but you have to look at kind of what happens, further down the road with liquidity, which I think has been a positive. And again, I'm not a political guy, and I don't particularly like the way Congress behaves, but I do think that what they did, how they did it, totally different argument. We'll talk about that some other time. But I think what they did by just injecting cash into the market, getting cash in the hands of small businesses, was it perfect? No. Did they get the money in the right hands as far as the unemployed? Yes, and it actually worked. It worked. So that's a good thing.
Well, you mentioned, too, that term trickle down, so it's important to note, just even I'll stick with that same example that you used with real estate. Think about everybody that's affected when someone buys a house. You have appraisers, you have lenders, you have home builders or home renovation companies, plumbers because you're having to get inspections done, and all of the different pieces that need to, or all the people that are involved in just a simple transaction of buying and selling a home. That in and of itself is just a microcosm of what's happening throughout the entire society. You're pumping money into one portion, people are spending it, and when they spend it, it goes all these different places.
Yeah.
I know I participate in a networking group called BNI, and I remember when you're building them, you've got to get interest from other businesses, and you have exclusivity. So everybody in the group does different things. And to Eric's point, you got all these tradespeople, different things, different professionals. And the best example that we ever use is someone relocating. In our situation in Louisville, so let's say a business owner, there's the wife owns a business, the husband has a good salary job at a corporation. He gets relocated to Louisville, Kentucky. Stand up in the room, and you might have 40, 50 people in there, all do different things. Who would be able to help this family in some way? Virtually everybody.
Right.
Virtually everybody, because when someone moves from one place to another, they've got we could spend a lot of time going into that, but that's what Eric's pointing out.
Sure.
Literally when anybody changes physically where they live, a lot of times that causes a lot of transactions, which is a good way to bolster the economy.
Yep. Mm-hmm. All right, so speaking of earlier in this podcast, I mentioned kind of this term of fiat money.
Is that the little car? Or?
There is a car called fiat, isn't there? I didn't even think about that. No, we're not talking cars. Those are little bitty things, isn't it? Yeah, okay.
They have one, I think, that has 4 doors.
Do they really? Wow.
I don't know. You want to sit in the back, but no judgment. They're great.
All right. So we're talking. So the second question that came up during my client meeting was, she said, with all this money that, the Federal Reserve is spending, all this money that we're spending, where does it come from? We already addressed that. And then she said, does it have any value? And I said, well, ironically enough, our currency is what they consider to be fiat money. And she was like, I have never in my life heard that term. And I said, well, I studied it only because I took my CFP and passed it. And actually, there was a 4 sentences about fiat money, and I didn't have a question on the CFP of the test about it, because I would have nailed it. But anyway, that's a whole different story. All right, so what is fiat money? If you want to look it up, there's a definition for it. But essentially, I'm going to read in my research. I just Googled it, really all I did. But basically, it's a government-issued currency that isn't backed by a commodity such as gold. That's all it is. So fiat money is essentially currency that essentially has no value other than the perceived value of what you can exchange a good for. Mm-hmm. So the example I was giving her, she had a mask on, and I said, here's an example, and I don't know if this is a great example. You guys probably come up with one that's better. And I said, if I had a $5 bill, there is no value to that $5 bill unless you perceive that $5 bill has value to it. Mm-hmm. And I said, you have a mask on. If I gave you a $5 bill and you gave me that mask for it, then my perceived value is that the mask is worth me giving you that $5, right? I said your perceived value has to be that you've received this $5 and you can go out and get more material, more elastic, in order to make more masks. Or if you go to the gas station and you get gas, then you feel like if you've given a person $5, you're going to get enough gas in your car that you perceive that it is worth $5. Mm-hmm. Right? Mm-hmm. That's maybe the best way I know how to explain it. I don't know. Maybe you guys have a better definition. But point being in all that is that there is no goal set a goal. Now, I did make this point to her. I said, if you remember back in the 40s, 50s, 60s, or whatever, we live in Louisville, Kentucky, by the way. So if you're watching this around the U.S., we live in Louisville. And about 35 miles down the road, there's a place called Fort Knox, which is a military base. But there's a little house, a little building that sits up on this little hill that's guarded by 700 fences and whatever.
All kinds of landmine. There's more.
Yeah.
Not a place you want to go mess around.
Yeah. But there was a perception at one point that that's where the national gold treasure was stored. And why did we own gold and why did we hoard gold? Is because that was what backed our currency at one point. So if we issued, in theory, again, air quotes, in theory, if you issued $1 billion of currency, we went out to the market and we bought $1 billion worth of gold. That's, in theory, how it all got started. But then we couldn't buy enough gold to ever support our economy. And so that's when we created this kind of fiat money, which essentially there is no currency to back it. Now they say there's nothing in Fort Knox because we've done away with all the gold. And all
it makes sense. I mean, the global society is never going to be able to have enough minerals
That's right.
to back all the currency forever. That's just, you can't continue to base currency on a mineral,
Yep.
no matter how valuable it is, like gold or something.
Yep. So what I wanted to do, and I brought this up to these two guys today, and this is the continuation of the conversation I had with the client. And they were like, whoa, dude, you're like way in the weeds, kind of like, buying the car. You were, but anyway, so here's what we're talking about. The paper money used to be how our economy ran, right? So you would walk in, you'd have either a coin that was worth something or you had a piece of paper that was worth something.
Yeah.
And then we created this thing called credit. And credit really was... it really had no, and I say credit, that's not an accounting term. I don't understand accounting, the debit and credit side, I never got used to. When I say credit, meaning somebody gave you, so if you deposited, $20 in your checking account, they didn't take 20 paper and put it into an account, they just gave you credit for it, right? Mm-hmm. And so when you went back to the bank and you said I need money, they took, withdraw, let's say you wanted $5, they just deducted your credits in your account by $5 and handed you $5 in cash, all right? Mm-hmm. So if you think about the way the world is constructed today, we're really not a currency-based, now this is my perception of it, we're really not a currency-based society anymore, if you think about it. We're really just a credit society. As an example, and you guys jump in here. As an example, today is Friday, and I happen to get paid today. I checked my account this morning. So I checked my account this morning. I got credit put into my account. It's not paper money. Nobody put paper money or coins or whatever. They didn't do that. They just gave me credit. Now, I happen to use a debit card and a credit card for pretty much 95% of my expenses, maybe 100% of my expenses, to be honest. So what happens is I go and use my credit card. If I go to, let's say I go to Kroger. Mm-hmm. I go into Kroger and I buy $50 worth of groceries. Credit, or a Kroger gets $50 worth of credit put in their account, less any fees from the credit card companies or whatever, right? Mm-hmm. So there's no money exchange. It's just a credit that goes in that account. At the end of the month, the credit card company says, hey, you owe me some money. You owe me, in this case, $50. Then all they do is take money out of my... they don't take money, sorry. That's not my point. I'm screwing up my philosophy here. They take 50 credits out of my checking account, apply it towards my balance, and it's paid in full. Mm-hmm. So really, we are a very cashless society. This is something one of you two brought up, kind of being a cashless society. Yeah. But we're really just a credit. So everybody gets credit. Again, I know debits and credits are a little bit weird, but you just get a credit assigned to an account, and that's really what we use to consume goods, right?
Mm-hmm. I mean, I go months without touching physical money.
Right.
I mean, I was probably ahead of the curve. I was doing that several years ago. I mean, many years ago, actually. But, I mean, I stopped carrying physical money years ago. Don't need it.
Yeah, I mean, I think, we have a home poker game, a little cash game. Virtually the only time I ever have cash, and I still, to get the cash, I go to Kroger, get beverage of choice, and swipe it, and then I get cash back.
Cash back, yeah.
And
Yep.
I used to be able to get some of that without even a cost, but now they charge me a fee for that cash back. But that's beside the point, because it is inconvenient. But now even at our poker game, people are kind of getting lazy about that. That's like even too much. So now we just sit there at the end of the game, we're like getting on Venmo. Our currency is poker chips during the game, and then we check the count of our poker chips at the end of the night, and we run, who owes what, and then we just sit there and Venmo money or Zelle money, whatever is convenient for anybody at the table. But I mean, that is even getting too much. Like, oh my gosh, I have to find myself with cash. That's troublesome, and it's also anyways, it's convenient. It's actually better record keeping, because if you had to track what you did with cash, it's actually kind of nice if people like us and our clients. It's nice to look back and see where things actually went. It's good record keeping. Being in a credit society, I mean, it is definitely cashless. I mean, I just don't know that many people that carry cash.
And how many times have I will say, I'm not going to ask you guys to admit this, but I will tell you that I know that I carry cash, and historically, and I'll go, what did I do? I know I had a $5 bill in my pocket, and it's gone. And I guarantee it's because I went in my pocket to grab something. I pulled my hand out, and a $5 bill fell on the ground, and somebody, 100 yards behind me found it, was like, hey, whoopee, I found $5. So when you're using a credit card, debit card, this doesn't happen that way anymore, right? So that's mainly why I do it. I just don't carry cash for lots and lots of reasons. But again, you can control it. You don't lose it. And there's all kinds of things about credit cards, which we'll do another show on my theory about credit cards. But again, let's go back and talk about, from the very beginning of the show, we talked about kind of, what's happening in the markets, the Federal Reserve, why the Federal Reserve, started pumping cash into the system. And it really was Congress to some extent as well. But when the Federal Reserve started pumping money in the system, and they started giving it to banks, they started... the Congress said, hey, we're going to do these PPP loans, and we're going to do EIDL loans, and we're going to provide $600 extra in the unemployment. Really, if you think about it, all those transactions were credits that were just applied to different bank accounts, be it into a bank to provide PPP loans, and then to small business checking accounts, and then small business would get this lump sum of credit into their account, and then they applied those to workers into their checking accounts in the form of payroll. Maybe they paid loans off or continued paid loans. Maybe they pay rent. In some cases, nobody paid rent. So again, it's just credits that continue to kind of hop around to different accounts. So with all that being said, that's just a conversation that we had with a client about what is the U.S. dollar. I thought it was a pretty cool conversation. She was blown away at some of the answers I gave her about how it works and what is fiat money. She'd never heard the term. So I thought we'd do a quick show on it.
Yeah, I mean, I think it's important. I mean, because, in our firm, we believe that education is paramount, and while a lot of clients won't ask a lot of these really strange questions, but when you do get them start asking the first question and you give them some feedback, they tend to ask the next one and the next one. And ultimately, we believe that educated clients create peace of mind, right? It's the name of the podcast.
Yep.
Which is why we're covering this topic. You might say, well, this is pretty nerdy. How does this affect things? Well, we just believe education matters, and understanding how things work matters. Functionally, as a firm, too, the fact that it works like this is easier for us to be independent as well, because Schwab's issuing the credits, with people that have stuff there. It's not on us as a firm. I don't think you could have had really small firms a long time ago when it worked that way.
Yeah, I agree.
It's easier for us just to allow the big institutions to do that kind of stuff, and then we're just really building relationships with our clients.
Yeah. So again, we'll just kind of wrap up today's show. I'll let Eric kind of sign us off in just a quick second. But just remember, if you're listening to the podcast and you want to know what we've talked about in the past, just go check out our podcast page. You'll see all of our previous shows. We do them on a weekly basis, so make sure you subscribe so that you'll get our new content. If you're watching us on YouTube, I apologize about the appearances, but this is who we are. But you can also see our contact information behind us. And for those of you on podcasts, our phone number 502-233-9800. You can come see us. You can, and we cover a lot of different topics. There's 6 of us in our office, so if you want to meet with any of us, feel free. We offer a 1 hour, no fee conversation, and it can be about anything in the world you want to talk about. It doesn't have to be specifically about estate planning or specifically about life insurance or specifically about retirement planning. You can come in and talk to us about anything. And if you like us, we hope you do business with us. That's kind of the point of this whole thing. But anyway, that's for another day. We'll have those conversations another time. With that being said, Eric's going to sign us off, and we'll see you guys next week.
Thanks a lot for listening. If you're watching on YouTube, check that little subscribe button and down there in the corner. If you're listening on podcast, please listen, subscribe, rate, and review. We appreciate it.
All right.
Thanks.
All right. Have a good week.
The information given herein is taken from sources at IFP Advisors, LLC, doing business as Independent Financial Partners, IFP, IFP Securities, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. This report may not be reproduced, distributed, or published by any person for any purpose without IFP's express prior written consent. Securities offered through IFP Securities, LLC, doing business as Independent Financial Partners, IFP, member of FINRA and SIPC. Investment advice offered through IFP Advisors, doing business as IFP, a registered investment advisor. IFP and Family Wealth Planning Partners are not affiliated. The information given herein is taken from sources at IFP Advisors, LLC, doing business as IFP, IFP Securities, LLC, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors.